So Clément is I mean, you can maybe introduce yourself more, but he's a PhD candidate, is my understanding. Just finishing up his final steps for a PhD, and he's an economist. And actually, he used to work at a bank at Société Générale in France, and so he knows the precise banking operations. And the reason why this is important to understand is because this is kind of the core of how the world economy works. And so you have to understand how things currently work if you want to improve on them or find opportunities to kind of link to a new decentralized ecosystem. So with that, why don't you take us away, Clément?
Thank you, Makoto. Thank you. So it's a very accurate introduction. Actually, I'm finishing my PhD, and what I'm going to present today is actually a part of my first essay, and I will go back to basics, basically, because I will introduce how payment flow. So I will just share my screen. So thank you very much for the invitation and for the opportunity to present this work. So I am actually a PhD candidate at the Université of France, and now actually living in Cambodia, Phnom Penh, where I'm actually finishing my PhD there, working on the dollarization of the country. And today I'm going to present, I would say, the payment basis of TRADE5, basically, trying to inject at least a bit of theory as well. Let's be mindful of the time. Right. So basically, in terms of money, I mean, to understand properly money and its construction, one approach is to try actually to decompose the money and to look at its components, its main components. And one, I would say, interesting distinction that we can make when we actually study money is to distinguish two core, I would say, elements, two core components: the symbolic dimension of money on one hand, and the infrastructure dimension on the other one. So basically, the idea is to say that money, the concept of money is nothing without the infrastructure. A euro or a dollar exists only because there are balance sheets, because there are money paper, because there are banking cards and all the infrastructure surrounding it. At the same time, an infrastructure without actually the symbolic dimension of money, which is nowadays very state-centered, but not exclusively, is just a computer or a server without any further dimension, I would say. So there's this complementarity between the symbol on the one hand and the infrastructure on the other, and that makes money. And there is another distinction that you can make to that extent, which is the distinction between public and private money. Public money being, for instance, commercial bank money, and the balance sheets and the liabilities of commercial banks. And public money might be, in this case, the central bank money as we know it. So basically a cash in circulation as well as commercial bank reserves. So in this case, just accessible to a certain part of the economic actors. And between symbolic money and infrastructure money, we can actually, I would say, inject or integrate three pillars. The usual three functions of money. Everybody might be actually familiar with them, with the unit of account, payment instrument, and reserve of value. The centrality of money. We have to assume that money is at the core of the economic system and beyond the economic system of the society as a whole. And the three forms of trust in money. And I will spend a bit more time on the three forms of trusts, because these ideas of three forms of trust, these concepts, derive from the French institutionalism. And these three forms of trust that are actually distinguished by the French institutionalists are ethical trust, hierarchical trust, and methodical trust. So basically, if we go to the ethical trust of money, it's basically meaning that behind money there is the social contract. When basically you use USD, Euro, or any form of symbolic money, somehow you adhere. Actually, you are actually belonging to a community, and you accept to belong to this community, integrating its values as well. The hierarchical dimension covers the stability dimension of money. It's like whatever happens, whatever strikes the monetary situation, it will at some point go back to the normal situation because there are safety nets, processes, institutions that actually guarantee the stability of money on the long run. So there is this idea, for instance, of the existence in the current monetary system of lender of last resort, for instance. This idea that whatever happens at some point, there are mechanisms to bring it back to normality and believing in long-term stability. And the methodical dimension of money is the habit. Basically, when you go to the shop, if I go downstairs and I want to order a coffee, I will not even think about it. I will use, I would say, a banknote, or I would use actually because I'm in Cambodia, so I can use Bakong actually to pay with my phone. So there's this idea that every transaction cannot be surrounded by a contract. Money is actually a daily and multi-daily contract that we enforce by actually transferring some kind of assets, some kind of actually liabilities of a given entity. And this day-to-day use is embedded in our days and our realities is what also constitute the trust in money through the payment instruments. So well, now that we, I would say, established some kind of framework surrounding money, let's go back to some basic concept in terms of accounting. And so I selected this picture because it's quite interesting. So it's not from me. I took it from a Cambodian newspaper, but you can see something quite striking, and everybody can see it in their respective town. But you have three banks in a row here. You have ABA Bank, Atta Bank, and ACLEDA. These are three major banks in Cambodia, side by side. And so the assumption or basically the use case that we will actually explore now is, how can you transfer money? Let's imagine that I have an account with ABA. I can transfer money to someone having an account with Atta Bank or ACLEDA. How does it work? What is the mechanic behind? So basically so like in this example, you have two participants. You have Société and PRAC for illustration. Société has an account with ABA Bank, so the first bank on the picture, and PRAC with Atta Bank, which is the second bank. So how can they transfer money to each other? The first option, the most straightforward, or at least the one deeply embedded in the I would say collective idea of how you transfer money, is basically pushing a lot of cash, right? Like Société can actually cash out some money at ABA, take these banknotes, may them be in USD or in Riel being the national currency in Cambodia, and go to the bank of PRAC and say, well, I would like to deposit this money to my friend. But this has, of course, like a lot of side effect as well in terms of cost. This is basically quite a risky operation, potentially very, very costly, depending on the amount of money you want to transfer. Potentially not even feasible if the distance is very wide. Not very convenient as well, because you have to physically go to your branch and actually transfer the money. So there is this first option, and the second, which is more, I would say, in line with nowadays payment system, is to use actually a digital payment system powered potentially by the central bank. It can be by the central bank, it can be by a private consortium or private entity. It depends on each and every country. But in Cambodia, if I keep actually using this Cambodian example, it's powered by the National Bank of Cambodia, which is the central bank. So they will power actually Bakong, the technical solution offered by SORA, and they will transfer the payment. So Société will instruct its bank, potentially going to the branch or using the banking app within a proprietary, I would say, interface, instruct the payment, and the money will fly. We'll see how, but the money will fly to the account of the beneficiary, and the beneficiary itself will receive a confirmation of credit, and potentially his bank will send a confirmation of credit as well to the originating bank, in this case ABA. So everybody is aware. So there is this first dimension of settlement. The money will fly from a point A to a point B through a payment system. But there is as well this idea of information sharing, because you want both the originator and the beneficiary to be aware of the good settlement of the information. So in terms of knowledge, but there is as well a very relevant dimension of information, because you have to make sure that when they discuss together about the settlement, ABA, Atta Bank, and the National Bank of Cambodia make sure that I would say the transaction they understand is actually the same, because otherwise there might be duplicates, there might be mistakes in terms of amount, delays, and you have actually the problems to settle after. So what about the accounting? In this case, like it's a very basic transaction, I would say, between two banks. So if we look at the balance sheet of ABA, what is going to happen when Société will actually instruct the payment to his friend? You will have a debit of his account. So basically, ABA will push or will remove a part of its liability, because the liability of the bank, one of the topic item on the liability side of the bank are customer deposits at site in this case. But you need to balance, and this balance on the asset side will be the transfer of assets, basically long balances, cash balances held with the National Bank of Cambodia, which is the payment operator. National Bank of Cambodia, on its side, because it's at the top of the pyramid, at the top of the payment system, will actually have two liability movements. On the one hand, the National Bank of Cambodia will debit the account of ABA in its books to credit the account of Interbank in its books. Because why the central bank is central? It's because actually all the other commercial banks have to open an account with the central bank. This is actually one of the prerequisites when you obtain a banking license. So to that extent, the central bank has this capacity of enabling the transfer of assets, being liabilities of the central bank, from one point to another of the financial system. So this is within a domestic space, of course. And ultimately, what's going to happen on the balance sheet of Interbank, this time the balance sheet of Interbank will increase because they will receive asset being a credit on their account with the National Bank of Cambodia, and they will reflect this credit on the liability side by crediting the account of PRAC, which is, in this case, an increase of their deposit base, outside deposit in their books. And the balance sheets are balanced and the transaction settled. Now, what about the accounting? If we look actually at the debit and credit, so this one is the payment flow. This is purely operational, but it's still interesting to understand how it works, because we hear a lot when we read about correspondent banking, typically, or just payments, about LORO, Nostro, Vostro, and this actually clarifies a bit this articulation. On the one hand, first, ABA will debit the account of Société, so you have a debit on the account of Société, and will credit a mirror account. So what is a mirror account? A mirror account is basically an internal account, an operational account that ABA will use to reflect all the transactions that are happening on its settlement account with the National Bank of Cambodia. And so by comparing the mirror account and the settlement account, ABA and every bank, I would say, using this double accounting standard, will be able to spot mistakes, spot delays, spot potentially fees and other kind of items via a process that we call reconciliation. So basically, if ABA instructs the National Bank of Cambodia to debit its account to process Société's payment, but at the end of the day, on the end of day statement, they do not spot the debit on their account with the National Bank of Cambodia, maybe the National Bank of Cambodia missed the message and didn't process the transactions. And by actually comparing their mirror account that ABA credited on their own with the real account that ABA is actually holding with the National Bank of Cambodia via the end of day statement, they will be able, by comparing the two, to spot potential discrepancies and to make sure to monitor what is happening in the real bookkeeper, which is the National Bank of Cambodia. So a mirror account doesn't have any accounting dimension. They can just reflect what is happening in the books of the bookkeeper. The bookkeeper being the one having a real, I would say, asset impact on the asset side of ABA. And ultimately, when debiting the account of ABA, consequently, I would say, the National Bank of Cambodia will have to credit the account of Interbank. And similarly, when receiving this instruction or this information from the National Bank of Cambodia, Interbank will debit its mirror account, so matching the two entries, and credit the account of PRAC, the beneficiaries. And you see that in this case, through like a hinge system, mirror account being kind of a hinge between the balance sheet and the rest of the world of the entity, the banks will be able to make money flow just by actually debiting, crediting, and adjusting the position of the balance sheet, transferring ultimately a debt that ABA and Atabank have on the balance sheet of the National Bank of Cambodia. So this is a transfer of debt. And in this case, money and the payment systems is basically a way to transfer liabilities in a pyramid of debt. And this idea of pyramid of debt, you can see it in the next figure, which is actually synthesizing this payment system. I just add another intermediary because I think that would be interesting for you, especially if you work in non-bank payment service providers, because it's an idea behind the prudential regulation. So in this case, we see that Société, they doesn't have an account directly with ABA, but they have with an intermediary which is named PayPay. So let's assume that it's a wallet that Société can use to process payments. In this case, it is a pyramid because at some point, debits turn into credits. So it goes up to a certain point, and from this certain point downward, the debits will turn into credit. So let's go with the figure to see how it works. The first option will be a transfer of cash from Société to Prague. And even a transfer of cash, if you think about it, is a transfer of a National Bank of Cambodia liability if it's a payment in real, because cash in circulation is actually on the liability of the balance sheet of the issuing bank. So in this case, you just do it, but with a decentralized physical, so basically a bearer instrument that you transfer from point A to a point B. But as we said in the beginning, this can be quite challenging if you have actually a large amount or large distance to cover. So this is the first option. Still involving, I would say, a liability movement only on the central bank side and an asset and liability movement on Société and Prague side. Option 2, Société will instruct PayPay. So PayPay will debit the account of Société, will push the payment to its own bank. Let's assume that PayPay is working with ABA. So they will instruct a debit again. ABA will now try to reach Atabank. To do so, they instruct the National Bank of Cambodia. And as we mentioned in the previous slide, National Bank of Cambodia will be the ultimate bookkeeper in this monetary system and will turn the debit into the credit, inversing, I would say, into a waterfall. So National Bank of Cambodia will now credit the account of ATA, and ATA will credit the account of Prague. So you see there is this idea of pyramid because the debits turn into credit as soon as they find actually a common settler, a common bookkeeper. But all the transactions do not necessarily have to be processed via the National Bank of Cambodia. So there is an option 3. Let's assume that, for instance, so many actually arrows, but the idea is to say that at a level below the National Bank of Cambodia, you find one bank having both the N-1 and both the N+1 participant in its books. So for instance, if Prague has an account with ABA, in this case, no need to go through the National Bank of Cambodia because Société will instruct PayPay, PayPay will instruct ABA, and ABA, instead of using the National Bank of Cambodia, will just credit the account of Prague in its books. So it will actually remain a liability-only movement, not involving any asset side, so not involving the National Bank of Cambodia. And this is extremely interesting because a bigger a bank will be in terms of customer bases, a larger the proportion of its payment it will be able to process on a liability movement. Hence, it will manage to have like a more aggressive asset and liability management strategy and actually maximize the yield, I would say, between the asset side and liability side. And this is a real topic because if you see, for instance, this example of shadow pyramid, so the bigger N-1 pyramid will be within the system, the less the payment system in the country will be used. You see it with the development of JP Morgan, for instance. JP Morgan, very large bank in the US. I don't have to introduce the bank, I think, increased its size in 2001 when acquiring Chase Manhattan and becoming JP Morgan Chase & Co. And got even bigger in 2023 when they acquired First Republic Bank during the banking system meltdown. And so this is interesting because you see that the more a bank will actually have a larger market share, the more they will be able to process transactions book to book or in-house, meaning processing via their liabilities without ever involving, I would say, the asset side. And there are many cases like this, like in Georgia, for instance, TBC and Bank of Georgia, if I'm not mistaken, the two of them cumulatively, they concentrate 80% of the banking assets. So basically two banks, 80% of the banking assets. So all the payments they make together, or that they will do like in their own balance sheet, or actually if they open an account with each other, it will be not even necessary to use the central bank for the transactions. And we see it as well in Switzerland with the case of UBS acquiring Credit Suisse, and both UBS and Credit Suisse actually were the largest correspondent bank in Switzerland, meaning that all the foreign banks willing to have an account in Swiss franc, were actually working with these two banks. And now actually it's very interesting because on the UBS side, what are actually the customers? Some domestic Swiss customers, of course, because there are these two banks, or the combined entity is one of the largest banks in Switzerland in terms of market share and customer basis and asset side, as well as the international banks, the non-Swiss banks, willing to have access to the Swiss franc, and in extenso their own customers. Because for instance, if I'm French, I want to process, I would say, a CHF payment. I will use my bank, and my bank will itself use its CHF correspondent. So there is actually this concentration. And on the National Bank of Switzerland side, you have the rest of the Swiss banking sector, so the rest of the Swiss domestic economy, the share which is non-actually banked by the newly merged UBS. And this is interesting because it means that now all the transaction between the newly created entity do not leave actually the balance sheet of UBS. The payment from the rest of the world to the rest of the world might not have to leave as well because the accumulated two were actually the largest correspondent banks in CHF. And the rest of the world from and to the Swiss customer of UBS still stay in the balance sheet. Well, actually, the payment system of the National Bank of Switzerland will be used only between the Swiss banks not being, or the customers working with another bank than UBS. So it limits very much the scope of the National Bank of Switzerland, the centrality of it, and it creates a kind of two central banks de facto, because the shadow pyramid of the newly created entity is extremely large. And so the exchange between the two will be from one customer to another. So I will go quite quick on this, but here the figure I would say illustrates how now the Swiss financial system, or the Swiss monetary system, if we just take into consideration the cash settlement, is polarized between two pillars: the National Bank of Switzerland on the one hand, and UBS being the newly created entity merging with Credit Suisse and having this centrality through a very large, I would say, a balance sheet. Right. Now we'll actually introduce one new figure, and so far we described the red part of this pyramid, the central bank on top, and the commercial bank at the level n-1. And now you can see that right under the commercial bank, you have the non-bank financial service, the non-bank payment service provider, potentially having these actors usually do not necessarily, in most of the jurisdictions, they do not have an access directly to balance sheet of the central bank, but they use actually an account with commercial bank to settle. And then on the bottom, you have the payment users, basically the non-financial companies, SMEs, individuals. So basically all the economic actors willing to access payment systems or directly via commercial banks, or via non-bank financial service authorities, financial service companies, sorry. So you have this relationship. M0, which is actually the central bank money, so a direct liability of the central bank, will be accessible to the commercial banks via the central bank reserves. In this case, for instance, in Europe, it will be the target 2 balances or the Fed wire in the US. And the payment users, the non-financial companies, SMEs, individuals, through the detention through cash in circulation. So basically having a 100 euro note in their pockets. On the hand, the commercial banks, they will provide commercial bank money to the non-bank financial institutions or financial non-bank payment service providers, as well as offering like the same kind of money to payment users and the non-bank payment service providers through potentially wallet or non-bank accounts will use actually will offer as well commercial bank money to payment users. And it is interesting to go into the balance sheet approach of the articulation between non-bank payment service providers and banks, because it has a very interesting regulatory impact. Because the banking regulation is rather heavy, if you think about it. It's rather heavy because it's focusing on stability, establishing consequently barriers to entry, while actually the non-bank payment service provider regulation is lighter to enable actually a contestable market. But the consequence of it, not to actually jeopardize the financial stability, is to create a strong balance sheet link between the two. So how does it work? So if you look at the balance sheet of the banking sector, what do you have? You have the cash balance and the equity, loans and outside deposits. So basically, in the banking sector, the loans are actually making the deposit, not the opposite. Sometimes we can read in the literature that deposits actually create the loans. It's the other way around. And this is this leverage, I would say, between the liquid asset and the exigible liabilities is what constitutes the banking model. On the other hand, the non-bank financial or payment service providers, they do not have this capacity. So the cash balance being, in this case, an access to the central bank via the reserve, via the settlement accounts, and so on. So there is this multiplicator and liquid asset under the current liabilities. On the non-bank payment service provider, it's slightly different. In this case, the credibility will derive from embedded or guaranteed one-for-one parity between the deposit. So if I have a wallet with a non-bank PSP, for instance, so a liability of the balance sheet of the non-bank PSP, I will be sure, in most of the regulation, that the PSP has to keep the same amount as a cash position with a commercial bank. Because to benefit from a lighter regulation or lighter, I would say, regulatory framework, the PSP has to, I would say, tie a hand on its back by actually guaranteeing the one-for-one parity in commercial bank money. So basically, the non-bank PSP contribute to the liability side of the commercial bank, and the commercial bank in this case is taking the leverage, but the regulation assumes that the leverage taken by the commercial banks is more managed due to the heavy regulation. So that's how actually the two worlds articulates together through, I would say, different requirements, hence different product capabilities or leverage capabilities. And on the other hand, all the operational balances, I would say, of the PSP, they will also be potentially with a commercial bank, but in this case, they can take risk as long as it does not involve the fund of the depositors, of the customers. This is a very customer-centric approach, because at the end of the day, the objective is to make sure that when you deposit money with a regulated entity, may it be a bank or a non-bank payment service provider, you will not lose the money. And this is an important factor, because it's tightly related to the trust, the hierarchical trust that we discussed as the first slide. Because at the end of the day, making sure that people believe that €1 with BNP Paribas, for instance, which is a French bank, has the same value as €1 with Crédit Agricole and €1 with Lydia, which is a non-bank payment service providers, is a core element behind the unicity of money, right? Otherwise, if you don't believe in the fungibility of the liabilities, meaning that one liability has the same value as the other, and you can actually transfer one to the other, in this case, the banking system is on the edge of collapse, and that's what happened basically in the US in March 2023, when actually some banks were deemed not reliable. So the asymmetries between the liabilities were perceived by the mass, by the people, and they start to transfer, for instance, money from small regional banks to the big four, being JP Morgan, Bank of America, Wells Fargo, and Citibank. And while some banks at that time were actually seeing their deposit fly away, some large banks perceived as extremely stable were collecting very much and increasing the size of the balance sheet and being even more liquid than they were before the crisis. All right. Next slide concerns the monetary flow. So I'm going to go quick on this, but I take the example of a cross-border payment. So now we stretch the pyramid away from the domestic system. And now you have a company A willing to transfer money to a company in Cambodia, willing to transfer money to a company B in Morocco. So from Canada Bank, which is another Cambodian bank, to Attijari Wafa, which is a Moroccan bank, in USD. So in this case, the process is the same. There is no rocket science. In this case, company A will instruct a debit to Canada to JP Morgan, because JP Morgan will be its correspondent bank. JP Morgan will instruct the payment via the federal system to reach BNY Mellon, which is the declared correspondent of Attijari Wafa. And ultimately, Attijari Wafa will credit the company B account. And this settlement will use, because you have the interoperability, in this case, you need interoperability between different domestic ledgers. They will use actually Swift. Swift is a language and a messaging company facilitating these kind of transactions by making sure that everybody understands the instruction the same way and can process them accordingly in their own balance sheet, making sure that what Canada expects will be processed the same by Attijari Wafa, that there is no misunderstanding in the meantime, because this is not just about messaging, it's about money, and money is about like liabilities and legal enforcement. So basically, if there is a duplicate entry, this is not just a duplicate message. And similarly, Swift connects the different monetary pyramid together. But for instance, when JP Morgan will exchange with BNY Mellon, most of the time they will use actually a proprietary message of the payment operator. So it is the case actually in the US. Where the Federal Reserve, the Fed New York, has its own messaging system to process the payment in its books. And so JP Morgan Chase will convert the Swift into a Fed message, instruct it to BNY, and BNY will convert the message into a Swift and push it to Attijari Wafa to enable the settlement to take place. Alternatively, and the same example as the previous pyramid, you can assume that JP Morgan Chase has the capability to facilitate or to settle the payment in its own balance sheet without involving the Fed. In the case in which JP Morgan Chase has in its book an account of Attijari Wafa, and in this case, JP Morgan will just debit the account of Canada in USD for the given amount and credit the account of Attijari Wafa while sending a Swift message. And by doing such a settlement, JP Morgan will not have to use the balance sheet of the Federal Reserve, hence the payment system. So there is the same idea behind correspondent banking of shadow pyramids. And so the two pillars of correspondent banking on cross-border payments. On the one hand, you have messaging. It's extremely important for you to make sure that when you instruct a given transaction, the right transaction will be processed for the right amount, the right value date, the right currency to the right beneficiary. Many information have to match actually to be able for the payment to succeed. And you have the settlement leg. So how the money actually flows from a balance sheet to another, leaving one pyramid to another. So the messaging, we use Swift, but this is not the only way. You can technically imagine that someone is actually instructing a debit or a credit using the phone. The problem of the phone is, of course, the scalability and the reliability of it, because you might have a misunderstanding and it creates even more operational risk in this case. The fax or the API. So we see actually an increasing volume of APIs. Like we were at the Singapore FinTech Festival just before actually coming back to this conference, and there is actually a surge of API gateways and connectors actually offering the same service as Swift, so enabling, I'd say, the interoperability between different types of balance sheets. While the settlement will take place in different kind of systems, financial market infrastructures, that you can locate on a spectrum, on an arbitrage between liquidity and risk. The real-time gross settlement system is actually absolutely not risky, but extremely consuming liquidity intensive. And at the other end of the spectrum, you have the deferred net settlement, which is actually more risky, but does not involve so much liquidity consumption. Being mindful of the time, I will maybe be quick on the different extremes, but basically RTGS, if you think about like a comparison, RTGS is a big wooden table. Every banker is actually sitting around it and transferring cash from one bank to another under the supervision of the central bank. So there is no risk for the banker because every time they have to process a payment, they receive the liquidity immediately and irrevocably from their counterpart. So they sure that the money, they have it in their hand, so they can actually give them, I would say, to their customer. Deferred note settlement is a bit different because you will only settle a net position at the end of the day in central bank money, but during the day, during the cycle, you actually, I would say, trust your counterparts. So you substitute central bank money during an intraday exposure on commercial bank money and you take more risk. But the advantage of it is you use less central bank money, which is actually a scarce resource and the best, I would say, form of liquidity you can find within a given monetary space. So these are basically the two extremes of the liquidity safety arbitrage. So in this case, yes, in the first example with the RTGS, you have 6 settlements for 380, while on the DNS, you have only 3 settlements for 100 euros, but still the same amount processed at the end of the day. The difference is that during the day, bank 1, bank 3, and bank 2, they will have to trust each other because if one is bankrupting at the end of the day, some will lose money potentially if they already credited the customers. So the clearinghouse is there for that, to be able to, I would say, roll back the transactions or act as a safety buffer, but still there is this inherent risk which the RTGS does not carry. The RTGS, the main risk is actually the operational risk of the central bank. So you have to make sure that when the central bank is actually telling you that your account is credited, it's actually the case and the central bank didn't make a mistake. But you, in this case, rely only not on the credit risk, but on the operational capacity of the central bank to perform its job. And so now, if you think about because in the previous example, we saw how payments are processed in a given currency from a pyramid to another, but it's quite interesting to see now how you change from a pyramid to another, including FX. So in this case, you change from a currency to another. So in this case, let's assume that BNP Paribas is willing to buy Mexican pesos payments to Mexican pesos liquidity to Banorte. And to simplify the example, we will assume that Banorte is actually the correspondent bank in Mexican pesos of BNP Paribas. So BNP Paribas has a Mexican pesos account with Banorte. But Banorte, they don't want actually euro, they want USD. They will be willing to credit the account of BNP Paribas if they receive USD on their account with their US bank, which is BNY Mellon. So BNP Paribas, they don't have USD, so they have to buy USD. So they will call actually JP Morgan, and they will say, okay, JP, are you willing to sell USD to me? I have an account with you. Can you actually credit my account with USD? And I will send euro to you instead. JP Morgan accepts. So they use Reuters, for instance, or any kind of trading platform. And JP Morgan will say, I will actually credit your account in USD, but you have to send euro to Deutsche Bank, because Deutsche Bank is my correspondent bank in euro. So BNP Paribas, using the European Central Bank payment system, in this case Target 2, will send money to Deutsche Bank. Deutsche Bank will credit the account of JP Morgan, and at the same time, JP Morgan will credit the account of BNP Paribas in USD, and you have this FX which is actually settled. Once receiving actually the USD, what BNP Paribas will do, they will instruct JP Morgan to send the payment to BNY Mellon for the USD to be delivered to Banorte, and at the same time, Banorte, receiving the USD from BNY Mellon, will, and from BNY Mellon meaning from BNP Paribas, will credit in MXN, the account of Ben Orte, and the settlement occur like that. So you see the interoperability between the different monetary pyramids and the settlement that takes place. The pyramids are not connected by their summit, but by their basis. And this basis is animated, entertained by a nexus of commercial banks. And when these commercial banks, they refuse to open an account, for instance, for a given country, which is actually the correspondent banking de-risking that we see in some geographies, they shut actually this geography from the rest of the financial system and it can be highly problematic. So basically, there is this centrality not of central bank money at the international scale, at an international scale, but of commercial bank money, which is actually driven by private interests and incentives. So how can we articulate facts and theories? We actually have symbolic money, infrastructure money and symbolic money in methodical. Okay, so the idea is to say that symbolic money is what we see when you have actually euro with a given bank or another. When everything goes fine, everything is actually I would say not distinguishable. But when the crisis occurs, then you will actually start to spot the difference between one bank and another. That's what happened in the US in March 2023. When the customers they started to see differences between regional banks and the top four players, preferring the top four players to the regional banks in terms of safety. So at that moment, you see that money is not only about symbol anymore, it's about symbol and infrastructure. And the infrastructure dimension of money is highly connected to the daily usage as well as the feeling that the situation will go back to normal. If you think that your bank will collapse, you lose the hierarchical trust. If you think that your bank will not be able to process your payments because they don't have enough liquidity, you lose the methodical trust. So this is actually how infrastructure and symbol, they connect to, so the reality of money and the infrastructure of money connects to the three level of trust of the French institutionalism. And if we look now at international scale, what is interesting is that the connection between two symbolic money occurs via private infrastructure money. So there's this idea that a commercial bank, by definition, is agnostic in terms of currency. You can very much open a USD account with a French bank or a Swiss franc account with a French bank. So the interoperability between a symbolic money A and symbolic money B would be performed via the infrastructural part and not any kind of infrastructural part by the private infrastructures, being most of the time the commercial banks, but not only when you have alternatives. But what is now happening with the CBDC, and I will actually stop on this to actually handle some of your questions if you have any. Basically, the CBDCs, if we think about the retail CBDCs, there is this idea of recreating the link between the central banks and the non-financial economic sector by actually creating a new form of digital liability, so an equivalent of the cash in circulation, but a digital form directly. And also another one, which is actually also an option that central banks are contemplating, especially in the UK. It's to enable the non-bank PSPs to have access as well to these new form of liabilities and offer a custody, I would say a custody service to their customers. So by having access directly to this new form of digital money, they will basically notch up and be on the same level as the commercial bank, because the capacity to be able to safeguard the liquidity of customers having a central bank account will actually challenge the structure that we saw together and level the playing field between banks and non-bank PSP, while at the same time ensuring safety for the customers, ensuring basically the fungibility of the deposit. So this is the first option. And the second one, when you look at interbank or basically wholesale CBDCs, being like a new digital form of RTGS, basically, there's this idea because today it's highly complex for a foreign bank to have access to, let's say, a bank in Germany to have access to a settlement account in the books of the Federal Reserve in the US. It's even impossible based on the regulation. But what the wholesale CBDCs and some projects like Ambridge offer is the capacity by actually holding on a given actually chain some form of asset, and this asset being connected to a liability of a given central bank, but it's a share ledger. In this case, it's as good as having a central bank account, because what you hold is actually a piece of the liability of the central bank issuing it. So there is this idea that such a ledger, even if it's not going, it's likely not going to be global due to governance issues. As Makoto said in introduction, the governance is always a key topic, but it offers the possibilities to facilitate for a foreign bank the fact to hold directly, so without an intermediary balance sheet, liability of a given central bank being the ultimate form of liability in a given currency. And that would actually make the settlement streamlined from M1 to M0 to M1. So in the bottom example, instead of the current form, which is M1 to M0 to M1 to M1, M0, M1, with the example, for instance, of BNP Paribas transferring USD at some point to BNY. So this is the example that might actually be explored by wholesale CBDCs use cases. But I think my colleagues from the Österreich National Bank will tell you more about CBDCs and the interoperability cross border. All right. Is there any question?
Yeah, thanks a lot, Clément. Let me see. There's a few questions in the chat here. So I have a few questions first, so I'll just start out. One question I had was, how often are errors found in reconciliation in the real world? Because theoretically, all this should just work, but I'm guessing the real world is quite messy.
Oh, you're right. Actually, reconciliation is basically most of the operations now in the banks having automated system. It's automated, right? I'd say that a good 95% should be actually automated. But for instance, some things cannot be. Let's say that, for instance, the correspondent bank is actually debiting fees on the account of its customer. Of course, it will appear as a difference between the mirror account and the real account. And in this case, the bank will manually say, okay, I recognize this because this is the fees. The fees are compliant with the conditions that we signed. So basically, we will actually credit the mirror account by debiting a fee account internally, and that's how actually we manage. So it depends very much on the transactions. And it depends as well on the accuracy of the Swift message, because Swift, the Swift standard before actually the ISO 20022 migration was very limited, and many free fields were used to process the payments where a large number of intermediaries were involved. So in this case, if you use free field, all the softwares, most of the banking softwares are not able to process the transaction or the reconciliation automatically. So it requires actually large teams. It's a very key core topic, I would say. And this is assuming that you have a good banking system, but in some banks, it's even fully manual because for instance, it's still paper-based. So like the Swift will be printed and someone will actually process the payment like that and perform the reconciliation at the same time. So it depends. But you'll be surprised, I think.
Yeah, the real world is always quite messy, and there's lots of details, and the details matter. I had a question about what is the effect in Cambodia of Bakong flattening the payments hierarchy, because you have both commercial banks and PSPs on the same platform.
Right. In this case, I didn't see behind in the specific case of Cambodia too much behind, I would say, the scene. But if I'm not mistaken, it would be in this case the case of a wholesale CBDC somehow. So if for instance a PSP, a non-bank PSP, has the possibility to open a Bakong settlement account directly with the National Bank of Cambodia, in this case is the situation where you level actually the playing field between the bank and the non-bank, because you enable them to have access to the balance sheet of the central bank. Hence, you have actually an ultimate form of liquidity, and you are able to guarantee the deposit of your customers, not using a commercial bank liability, but in this case, long balances with the central bank.
Yeah, it kind of talks about your idea at the end of creating a common platform that can simplify settlement. And yeah, if more countries adopt this in a cross-border sense, I can see how it could make a big difference. And in fact, as you mentioned with Enbridge, Nexus, lots of people are talking about these ideas. So we'll have to see where it actually goes.
But it goes as well beyond like CBDCs, I would say, because this discussion, as you say, when you quote Nexus, there's this idea as well for instant payment system being actually I would say DeFi centered. In this case, they might actually enable some non-bank PSP to have as well a settlement accounts with instant payment system. Think about Tips in Europe, for instance, or FedNow in the US. If in the future some non-bank PSPs have the capability to access settlement account directly with the payment operator, being in this case like the central bank or central bank liabilities.
Yeah, well, Bank of England already opens up accounts for some large entities.
Right.
What are the options for countries that have been de-risked, like RMI and Nauru come to mind? They have a hard time, or will in the near-term future have a hard time accessing global settlement.
Yeah, that's extremely challenging, right? Because about 80% of the cross-border transactions are still settled in USD. So when you don't have actually a USD correspondent bank, it's extremely difficult for you to take part, I would say, or to be part of the global value chains. It's a risk for your trade. It's a risk as well for your people, because if you have, for instance, if you rely on remittances, it's extremely either difficult, either costly, either both. I would say to process the remittances and if they are vital for your economic system, it's quite challenging. So one option is definitely to use in this case another currency, an alternative currency, because in this case, if other currencies accept to open a bank account or a correspondent bank account, that might be an option. This is not always like suitable. Otherwise, some banks, and this could be a discussion in itself, but some banks, I would say, offer what we call a nested account. So you will be a bank, for instance, in Vietnam, let's say, and you will go in Singapore and you will open a USD account in your books, but you will not actually enable an interoperability beyond your balance sheet. So do you hold a USD? Not really. You have actually a USD liability of a Singaporean bank, and you will enable, for instance, a bank in Nauru to process payments to other banks in the rest of the world having USD accounts with the given Singaporean bank. And this is this game to create kind of still is the same idea, right? To do liability movement with no asset side movement is also a second best, which is of course limiting first the scope of or the reachability of the payment solution, and second, it's not the same risk. Do you really own USD? That's the question at the end of the day.
Yeah, it's interesting. So what are the options, or what are the opportunities, I should say, for SORA version 3? Like if you were designing a new crypto economic system, what would you do?
No, but as you said, like the idea behind like, because what is the as far as understood, because I'm not from the crypto sphere, and I attended DEF CON last week in Bangkok. I had very interesting discussion, but I understand that one of the big challenges these days is the on-chain off-chain transition, right? And to be able first from a chain to another in terms of bridge, but if we exclude this, is the ramp between on-chain and off-chain. And in this case, like as you said with SORA, like the idea, if you have the capability behind to create a real ecosystem that can be actually managed end-to-end on-chain, definitely without the necessity to transfer at some point or to convert, I would say, the balance into USD to be able to spend the money domestically or to access services. I would say that this is definitely a way to tackle these challenges, like the idea of a legal tender of a use, even if it's I mean, many challenges ahead for sure, but it's a very interesting approach.
Yeah, certainly one of the goals of V3 and the hub chain concept is to create a platform that many players can join, and this could be central banks, it could be other types of entities, companies with big supply chains. They can be in the same ecosystem, and that gives interoperability becomes more or less instant within a couple seconds. Of course, you still have compliance and different rules, and that's why moving in and out is not necessarily going to be permissionless. It will have to have some kind of rules and permission checking. But when you're in the regulated financial space, you have to have some kind of access control. There's no way around it. Let's see if there's any other questions. I don't see anything else. So thanks a lot, Clément, for your time, and it's very valuable. And thanks a lot for making the time for us today.
Thank you, Makoto.
An ancient prophecy foretold an eclipse that would open a portal to a mystical world, the world of Soratopia, where honor, valor, and swords determine your fate. You can become one of them. Choose your path. Become a true samurai. Explore the vast world of Soratopia. Defeat mighty bosses in various locations. Your sword is your strength and honor. Don't worry, you're not alone. In Soratopia, you'll find loyal waifus to relax with. Engage in the game, pray, complete quests, and accumulate points to become eligible for a massive airdrop. Your path determines your destiny. Choose wisely. The eclipse has awakened, and so have you.
I just get the feeling we are starting to love again. Feel like we are only getting started. I just get the feeling we are starting to love again. Feel like we are only getting started. I just get the feeling we are starting to love again. Feel like we are only getting started. I just get the feeling we are starting to love again. Feel like we are only getting started. We've got light in the soul, let it shine, let it go. See how high we can go, see how high we can go. I just get the feeling we are starting to love again. Feel like we are only getting started. I just get the feeling we are starting to love again.